All right. Hey, good morning, everyone. Welcome and thank you for taking the time to join live. We've had quite a bit of rain over the last week, so I hope everyone has uh, gotten a little bit of rest and gotten everyone's crops off to a great start. So let's jump right in here. We've got a lot of information to digest. I'm going to hit the fundamentals really quickly, and then we're going to spend quite a bit of time on the longer term charts here this morning because I think that they've got to be our guide, and we don't want to get lost in the minutia of the shorter term of the shorter term charts. So fundamentally, really, we've got two things happening, or three. We have oil breaking um, out to new highs, and we have this continuous strengthening of gas prices, and demand just exploding for energies. And there's a lot of reasons for that. But a huge component of it is the policies both here and in Europe where we have discouraged production. We've had all this green energy push over the last several years, and so we've tightened emission standards. We've made it more and more difficult to refine all of our raw materials into usable energies, and so what that's created is a shortfall. And so there's a lot of talk of countries in the world not being able to harvest their crops or meaningfully move because they're flat out going to run out of diesel, because we simply don't have the refining capacity to keep up with the demand that we're seeing. So that's causing oil to really explode. And and I don't think we can lose sight of that. And I don't think that I think that the wrong assumption is to assume that that doesn't really impact grain prices, for two reasons, right? First is ethanol. We produce about 15 billion gallons of ethanol. We have a mandate to use that much, and refiners always say they hate it, but yet they gobble up every gallon of it that they can. And if you've got RBOB gasoline trading at $5 a gallon and ethanol trading at 250 a gallon, it should be a no-brainer that you want to blend as much of that into your supply as you possibly can. So I think it's extremely bullish ethanol and its byproducts. So and the same with biodiesel. We need all of it that we can get in order to meet this demand. So oil is very, very important. And I think that that can overshadow the fact that our crop is off to a great start. If you read the literature this morning, what you're going to read is you're going to read about a heat ridge, and you're going to read about how wonderful the crop, how wonderful of a start everyone has. Right? We've got lots of moisture. The crop went in the ground. We're back ahead of pace, with the exception of soybeans, but king corn is off to a great start. And so we should have no reason to think anything less than trendline yields. And then we end up with a weather map this morning. Let me see if I can find that here. I've got my controls. That looks like this. Our 8 to 14 day. You guys all know what this is. You can all recognize what that is. That's a heat ridge, and that's moving into the week of June 15 to 21. So hot and dry moving into the end of June. Okay, that could be supportive of prices, but not really this supportive of prices. Definitely not for soybeans. That's not enough to move soybeans $1 when you have when you have when you're already at all-time highs, and you have the balance sheet according to the USDA, which should be expanding because of the terrific start our crops off to, and because of the potential of South America growing a massive crop. So something else is underpinning that move. I don't think it's weather. I definitely don't think that you're going to kill a corn crop with the start we've had, with this type of weather setup. Now, if it persists into all the way into pollination, and it does get hotter and drier, and we truly don't rain, then of course we have other issues. But I think at the moment, I think people are just going to welcome the heat. So I think that this forecast should actually be viewed as bearish, the corn market, not necessarily bullish, because we need the heat. And I don't, so it's a little bit mystifying to see the corn market exploding the way it is, and beans, when you have the weather being so cooperative. Now, so that should point your attention to something else that's driving it, and that could be the war in Ukraine. So let's go through those headlines real quick. The Russian minister met with Ukrainian and UN officials in Turkey today, starting last night and into today. And we really haven't heard a lot of information and news about the about how those talks went, other than words like constructive, meaningful. They weren't contentious. Nobody shot each other in the meetings or anything like that. So maybe there's some hope on the horizon that we're going to wind that conflict down. But then you need to overlay Putin's comments over the weekend, and his actions over the weekend. So his comments were given during a speech that he gave last week, and they were he pretended to be mystified about why grain's not flowing out of the Black Sea region. He just doesn't understand, because he's not the problem there. After all, the Ukrainians are the ones that mined the Black Sea, and they started it, and he's not doing anything to impede the flow of commodities out of the Black Sea region. And as he's giving that speech, they're blowing up a grain terminal right on the Black Sea, right on the southern border of Ukraine. So he's saying one thing, he does another. He's caused massive damage to their infrastructure. If you look for pictures and news of the Ukrainian people, there's 15 million of them that have been displaced. You have their kids that should have been going to their proms, taking pictures in front of their bombed out high schools. So to say that there's no impediments to business as usual in the Ukraine is just completely goofy. They're going to be decades in the rebuilding and getting back to normal. So the Ukrainian grain minister and grain council is saying that they have basically over half of their crops will not be harvested because they can't get diesel. They have very little hope of exporting anything. So I think the conclusion out of the meeting with Russia is that they have no idea what's going to happen, and there's no conclusiveness there at all. So okay, this is the daily July corn chart. Okay, last week we had the big liquidation event. We dropped all the way back down to 720 a couple of weeks ago. We talked about the importance of this low right here. Let me zoom in on it so you can see it a little bit better. We talked about the significance of this low, that if this low were broken, then we would have left behind a three-wave move in corn, and we thought that was a good opportunity to move to the sideline on new crop or on old crop, and so it did, right? It opened up a move right down to this red line, right to the bottom of our cloud, and now we've rallied. So now the question is, are we done going down, or do we have more weakness? And on this chart, I think you can say it's 50-50. We don't know. If we move higher and we come back out of the top of the cloud and we take out this little intermediate swing high at 780, then I think you can talk about, hey, now we have a higher high and we're back above our cloud, and we've created a little bear trap right in here, and that would certainly point to higher prices and be bullish. But before that happens, all we're doing is coming back, testing the top of our cloud into resistance, into a prior swing high that failed right below another one, right? So you've got two little swing highs right here that failed, and that should serve as a little bit of resistance there. So corn's got some work to do to come out of it. if this were just a normal weather scare, then I think we'd be selling this, because I don't think you want to bet on the temperatures that we're seeing as a crop killer, and to think that that's going to be the catalyst to move higher. And it doesn't matter that that's what everybody's going to talk about. That's just not the fact. What's going to propel this thing higher is a much, much broader and larger bullish impetus, like oil exploding on up higher, general commodity index blowing higher. It's the inflationary tailwind that is going to break this thing back on up. But until we get to that point, we can't be sure. So I think we've got to look at your longer term charts to figure out where we really sit. So here's your weekly corn chart, and this is a continuation chart, which continuation simply means that it's always the front month. So anytime we roll, like this setup right here would have been a roll from the May to the July contract last year. So it's always the front month. It's always the most active and most liquid. So it gives you a great interpretation of what traders are thinking. And what do we have? Well, so far we have an inside week. We have this big liquidation week last week. Now we have a consolidation period. We fell right into weekly support, and we've been unable to muster the strength to break below it. We also haven't done anything to negate this big week yet. That's the significance of that 780 level. That 780 level comes back through this open of last week, the close of the week before, and the close of the week prior. So if 780, 782 is able to be regained on a closing basis here, then we're going higher. And if you want some targets for where corn might be going, then you need to use our Fibonacci extensions from the prior swing bottoms. So we drew this one all the way back on September 7th, based off of the decay from the May 3rd peak all the way down to last summer's or last fall's low, all the way down at 487 on the continuation chart. And if you run some extensions off of that, then your first target is 884, and then you're up at 950, and above that you're up at all the way at 1130. And if you run a Fibonacci extension off of the most recent decay here, off of this move from April 25th down to last week, and you assume that that's a good low, then we're looking at, somewhere right in this 880 sweet spot, all the way up to this 950 to 10 range would be your second extensions. So you got to just assume that that's where we're headed if we break that 780 number. And I think that the headlines are all gonna say, oh, it's all weather, and but I think there's something much bigger that's going to build that. So now the next question is, do the funds have room on their balance sheets in order to push this thing higher? And the answer to that is a resounding absolutely they do. They've trimmed about 45% of their long position over the last month and a half. So they have even by historical context, they have a very small and manageable long position. Remember, these funds just went through an event where the CBOT more than doubled what their position allotment sizes are. And so they're trading less than a quarter of what they can get long. And guys, I'm telling you, if we get into a global commodity melt up with a hot and dry forecast, with a balance sheet here in the U.S. that could come under pressure, they will use that allotment, because they've got, we just printed $6 trillion and they have all of it. So they don't have any financial restrictions for what they can buy and what they will buy if they think that's what's going to move. So I think the setup here is really, really bullish, but we got to get through this little short-term question mark as to just how where we're going to go. And I think 780 is the key. Below that, I don't really know what's going to happen. I think we just got to stick with our cloud, and as we get below it, we need to start hedging, and if we're above it, we need to stay really long, because we don't know exactly how high we're going to get. All right, let's look at soybeans. These are totally mystifying, and I think the fact that they're moving higher is very supportive of the argument that there's something bigger underpinning the move. The USDA has been telling us for a year that the soybean balance sheet doesn't have any problems. We got a little tight last year because China bought it all, but now they've trimmed their hog herd. Their soy meal demand is sluggish. Our soy meal demand is sluggish because we're just crushing the bean for the oil. South America is going to grow a great crop. We've got our crop off to a good start. We're going to grow it with normal weather. We've just got no issues running there. And yet here we are at new contract highs overnight on absolutely no real soybean news. I know that we're a little behind planting pace, but um, yeah, I think you've got to really roll your eyes at the idea that the current setup we have is going to produce anything other than a monster crop. We need a lot more damage before that happens. So what's driving it? Well, it's the fact that China's lying about their soy meal needs. That's why they've been buying 8 to 10 cargoes over the last 24 hours. They're short beans. South America, their crop is way overstated according to the USDA. They're trading over $20 beans in China. The basis levels in South America are about $1.50 to $2 premium to ours, and they're canceling shipments because they don't have the supply. So there's something amiss here that doesn't make any sense, and that's against a backdrop fundamentally of soybean oil being used for aviation diesel. Remember, we're replacing jet fuel with soybean fuel, and we need to basically quadruple the amount of it in order to meet the new Green Deal initiatives for avgas. So there is an overwhelming amount of demand for soybeans, and I think that's what's underpinning us against this fuel market. So as long as petroleum stays high, I think beans are have a possibility of going much higher. You run your Fibonacci targets. We've been looking at these for a while. 1830, 1850 is kind of a starting point. Above that, you're much higher if something happens. The strongest moves typically happen when they're adverse to the fundamentals. Think August of 2020, when we should have taken corn to $2 and we couldn't. That was the beginning of something of this entire rally. Soybeans have no reason to be where they are, and yet they are. So I think that in and of itself is a massive bullish catalyst for soybeans. So not looking down anytime soon. We'll let price action tell us at some point in time, but the all-time high is right here. So we're a hop, skip, and a jump after breaking up out of this formation from it. Wouldn't be surprised to see it today. Wouldn't be surprised to see it tomorrow or Friday. And certainly, unless something changes, I don't know why we wouldn't trade on up higher. Okay, let's talk about wheat. Wheat's been pushed around and is off from its high. So let's talk about relative risk reward. The presumption is that if all of our issues in Europe get solved, or if India exports too much, then we must take premium out of wheat. And when our harvest starts, we're going to take premium out of wheat as well. Well, there is going to be some harvest pressure, no question. But I think the funds are going to jump all over that and buy it, because there's not been any resolution out of the Black Sea, and there's been no resolution anywhere else in the world on a supply standpoint. So wheat is short supply. There's no other way to put it. And so if you're looking at this and you got to put your fund manager hat on, you've got two really nice lows to trade from, 1086 and 994. So you've got about $1 window here in order to measure your risk against. And what's your upside? Well, 1380 is the contract peak. If you run Fibonacci extensions off of here, I'm running out of time, so I won't. They're up here at $15, $16, $18. So you're talking a 250 move back to the peak to potentially $5 or $6 of upside against $1.50 risk. What are they going to do if wheat trades a little bit lower? If if it breaks, they can always reverse that and go short if they think it's going to go back to $4, right? So they can risk $1.50 and then take it down to 4, and they still make a tremendous amount of money. Or they can just sit and hold their positions and wait and see what happens. Because if corn starts to move, wheat's got to go with it because it's its cousin, right? You can't let that corn wheat spread narrow too much, or else we're going to start feeding it, and we don't have it to feed. So I think wheat's going to be underpinned by corn strength and by the bullish fundamentals coming out of the Ukraine, and I don't see any reason to sell it. We did tell people yesterday that if you're really worried about it, let's just defend this $11 number and make sure that these lows are safe for us. I see no reason not to do that. We've kind of liked that $11 number for a while. So if you're uncomfortable and you just want to have that insurance in place, then this is a good reason and a good use for that insurance, even though technically this is probably a better buy setup than it is a sell setup. So that's where speculating and risk management differ a little bit, but I certainly understand wanting to defend this at the profitability levels that we currently have. Okay, that's a lot of information for you. I think we'll keep watching it day by day and week by week, and as things unfold, we will be quick to let you know. There is tremendous risk in trading futures and options, and you should only do so in light of your own financial condition. If you need to talk through any positions or have any questions for us, please reach out. We are happy to walk through whatever it is that's bugging you. Hope you guys have a great week. We will talk to you next Wednesday.